A constant worry for people looking into entering today's market is securing a stable and affordable mortgage rate. Obviously, this can make a huge difference in your financial future. With the Canadian housing market experiencing significant fluctuations, knowing when and how to lock in your mortgage rate is more important than ever. Today, I want to go back a little and explain from the beginning what to look for when looking for a mortgage. My name is Aguinaga, your real estate expert here in Montreal. My mission is to guide you through the buying or selling process of any real estate transaction, and one of the most important steps is financing. That is why today I want to talk all about this important topic and answer any questions you may have. If you like this video, let me know in the comments down below and share it with anyone that might benefit from it. Let's get started. What does it mean to lock in a mortgage rate? In Canada, we can secure a rate for a mortgage with an institution that has pre-approved you for a period ranging between 90 to 120 days. This means that if you go to the notary within that time period, the rate you were given is protected. It doesn't matter if rates went up between the time you received your rate and the closing date, as long as you respect the timeline. This is great when rates are going up. You have peace of mind knowing that your 4.5% rate will be protected if rates go up to 5.5%. It's also important to note that if rates go down, you'll benefit from the lower rate. The amount of time depends on the institution offering the rate lock or guarantee. All institutions will offer a 90-day rate lock, but some will go as far as 130 days. I've even seen one institution do 180-day rate lock promotions at times. In the current market conditions, we're seeing rates trend downwards. Even in these conditions, I recommend a rate lock. There is no downside to it, and if inflation happens to come back above 3 or even 4%, chances are rates will go up again. I would always take the rate lock to hedge against this risk. Now let's look at some of the pros and cons of locking in a mortgage rate. Well, pros, nothing to lose. You're protected regardless of what happens in the economy. Cons, you need to send all of your financial information in order to get full pre-approval and qualify for the guaranteed rate. This is standard practice, so it's tough to consider it a con, but it's about the only one I see if we're being honest. When and how to lock in a mortgage rate. I would get a rate lock from the time I start shopping for a property. There's no negative to locking in a rate since you're protected if rates go down further. In order to lock in a mortgage, simply ask your mortgage professional when doing your pre-approval. Let's discuss the impact on different mortgage types. When talking about mortgages, we first need to discuss whether we're getting an insured or conventional mortgage. An insured mortgage applies to consumers putting less than 20% down to purchase a property that they intend on living in. The purchase price must be below $1 million, and an insured mortgage typically comes with the best rates in the industry. This is because the bank effectively has no risk on this loan. If you were to default, the mortgage insurer would cover the cost of the loan to the bank. This doesn't mean that you get to keep the property. It simply means that the bank isn't taking the risk. The insurer is. An insured mortgage comes with an insurance premium that is added to the cost of borrowing and included in the mortgage. A conventional mortgage is a loan where the consumer puts at least 20% down. It can be to live in or for investment purposes. The rate on a conventional mortgage is typically 20 basis points higher than its insured counterpart. Next, we have two types of mortgage rates, fixed and variable rates. Fixed rates are pretty straightforward. You sign the rate today, and for the length of the term, there will be no changes to your interest rate. It's important to note that if you have to break your mortgage contract before the end of the term, you will have a penalty to pay. This penalty can be quite hefty. I recommend you ask your banker to run through a few penalty scenarios based on breaking the mortgage at different times. Now, for variable rate mortgages. As the name suggests, the rate can vary depending on the economic state of the country. Variable rate mortgages are tied to the prime rate of Canada. Your rate will effectively rise or dip every time prime changes. Most institutions will offer a discount on prime, say prime less 50 basis points. For example, prime is 6.7% today, less 50 basis points, your effective rate would be 6.2%. The nice thing about variable rate is that the penalties are often significantly smaller. The penalties for breaking a fixed term variable mortgage is simply 3 months of interest payments. If you're simply looking for more flexibility, I highly recommend this option. Now, a few questions to ask your lender. Before signing a mortgage, I always make sure to ask the following questions. Can I see the best rates available for fixed rates on a 1 to 5 year term and a 5-year fixed rate variable? This allows me to assess the best option for me, given the different options available. What are my options for additional monthly or yearly lump sum payments? Different banks offer different terms for this. It's important to know what your options are. What's the penalty if I break the mortgage early? Honestly, I want to know how much it's going to cost me. Depending on how much time is left and what the rate differentials are going to look like, it's going to be different figures, but I want to understand how they're calculating it so that I can be informed when the time comes to make the decision. How much time do I have to port the mortgage if I sell the property? Porting is the mechanism of transferring the current mortgage to another property. We can usually do this when we're selling the current property and buying another property of greater or equal value. Some banks offer 90 days, others 120 days. Porting the mortgage saves you the penalty, which is why it's so advantageous. Before I conclude this video, I also want to highlight that different banks have different ways of qualifying you for the loan. Some banks will use your notice of assessments, others will look at your last 6 months of deposits, and some may even consider future revenues if you're a healthcare professional. When purchasing multifamily investments, different institutions use different ways of calculating the revenue of the property. Some will take a portion of the rents, others will use market rents, and some will use different sets of expenses when qualifying you for the property. When shopping for a mortgage, it's important to not feel defeated if one bank says no. I can no longer count how many times a client was initially given a less than favorable outcome from one institution only to get exactly what they were looking for from another. Make sure to shop around if you believe in the loan and in the property. Now you know it all, and I hope you can make an informed decision without sacrificing time in the market. We discussed the different types of mortgage terms, rates, options, and finally, what to ask your mortgage professional. What are your thoughts on looking for a mortgage in the current market? Share your opinion in the comments down below, and don't forget to subscribe for more real estate information. Once more, thank you so much for watching.